All right, good afternoon. My name is Jeff Leppert. I'm the Senior Vice President of Capacity Solutions for Redwood Logistics. And today I'm going to take you through some key industry indexes and a couple other segments of the truckload market and how to navigate it. One of the things we'd like to do in this seminar is ultimately give you a shipper point of view as well as a carrier point of view, and then obviously provide some of the expertise we have as a logistics service provider and intermediary between shippers and carriers. A couple of housekeeping notes. You should all be muted if you wouldn't mind, or please mute your phone. I'm going to go ahead and talk for an hour. That's a lot of talking. And so I'll try and slow the pace down so we can take notes. But if you have questions or concerns, what we'd like to do is obviously have them submitted so that we can address them for the entire group and not derail the conversation or the presentation that we're trying to accomplish today. So again, we're going to afford the ability for you guys to have questions. We encourage them highly, but we'd like to give a comprehensive response to share with the group that's participated. And before I go any further, again, I just want to thank you for taking your time out of your day today to join us for this. I know Monday afternoons can be incredibly busy. Again, thank you for joining and giving us the opportunity to teach a little bit about what we think is happening in the truckload market. So we kind of separated this into 4 segments. The first one is going to be a state of the market. Then we're going to walk through the cyclical and non-cyclical patterns associated to the truckload market. And then we'll go into the contract and transactional markets, as well as the ultimately with the rates associated with them. And then we've ultimately narrowed it down to 3 key things that are impacting the truckload market as it relates to technology. Before we can go into what the market looks like currently, it's important to frame out the market for everybody. And so these are some high-level facts that I think are important, which help frame, again, the rest of the story that's going to be told this afternoon. But it's almost almost $1 trillion at the end of 2020 in annual freight revenue in the truckload market. So it's gigantic. And there are almost 900,000 carriers in this market, so also gigantic. But the key statistic here that we can identify is the fact that there's not a lot of big guys. And so because there's not a lot of big guys, it's really important for us to leverage technology to try and find the little guys that are in these markets. And so when we look at supply chains and we look at anything that's associated with truckload freight, we ultimately end up spending a significant amount of time paying attention to the geography. So most trucking companies that are, again, they're small, start off in a head haul market. It's a relationship between a carrier and a customer that starts off with, hey, I have some freight, would you like to haul it for me? That's how the first truck begins. And you build a network off of that. And that's why we have so many little trucks. The other things is that trucks are incredibly expensive. And so there's a barrier to entry when it comes to a cost of entering the market, in particular as it relates to fuel and insurance. But the key here is going to be one of the things that's helping these truckers enter the market, stay there, is ultimately visibility to freight and ease of finding freight. There was a time where you used to stop at a truck stop and look at a board and try and find your next available load, or you would basically fax and receive a fax from a truck stop and pull over. So we've obviously progressed in the last 30 years to making it more convenient for drivers to find loads, but it doesn't necessarily mean that these fleets are getting bigger. The fleets continue to stay in what we consider to be a micro environment. I take a deeper dive from the 97% that had operate less than 20 trucks. It's not like there's a lot of those either. So ultimately 91% of the trucking companies operate less than 6 trucks. Again, I think here the points to make here are going to be that it's a quality of life concern. There's insurance costs. You have to find drivers for each one of the trucks. There's some volatility in the income, which we speak to here. And so because of these things, this demographic of the carrier network isn't going to change anytime soon. So it's how we navigate and understand the supply and demand curve when you know that supply is this diverse or fragmented. So now you move into the state of the market. Now there's a lot of ways to look at the state of the market. And one of the things that you'll notice here as we go through a couple of these is they're all very similar in regards to their readouts. And I recommend any one of them when you're looking at business decisions that you're looking to make, because they all offer different points of view Some of them have proprietary research, some of them don't. But we'll walk through some analyst ones from Morgan Stanley, some industry experts from DAT and Truckstop, and then we'll follow it up with some FreightWaves information. So we'll start off first with the Morgan Stanley. And the Morgan Stanley, again, this is an analyst, and so they have proprietary data that they aggregate from shippers, from carriers, from stock charts, whatever it might be, but they have a ton of information that they basically create a supply and a demand curve, which is one of the reasons why at Redwood we do like and review the Morgan Stanley on a weekly and monthly basis. What I like about this index is they basically level set it at 1 to 10. It's not hyper detailed. They basically just said, hey, this is the information that we have. It is best seen on a chart from 1 to 10. It does help, and it keeps it relatively simple and something that can be incredibly complex. What you'll notice here in the actual data is it's a 7-year pattern. But what you'll notice here is the market, ultimately the flow or the waves in these lines. The industry reacts to market events. If you don't have a market event, the wave in the line ultimately is muted. But the second that you have a market event, the wave becomes a little more seismic. And what you'll see here in 2014, that yellow line, that reflects the polar vortex. So we had a huge wave there. In 2018, the purple line, we had another wave. And you'll also see that in 2017, we saw toward the Hurricane Harvey market, the wave started beginning and the rate started staying higher, which basically led to the higher 18. Fast forward to 2019, which is the gray line, that was a muted year. And so ultimately with a muted year, you get a less volatile or ultimately a weaker market demand index for Morgan Stanley. Now, if you jump into 2020, we start seeing our waves again. And so the March 28th wave, that's entirely COVID. And we're going to spend a significant amount of time today talking about what COVID's done to the truckload market. But this is just a key indicator that you can see that we had our first wave in March. And then subsequently, we have our highest reading in August that we've had in the last 7-year pattern. Now the question is going to be, and I think everybody on the phone would ask this question, is going to be what's going to happen next. Morgan Stanley often gives a straight line analysis, but again, it's a straight line analysis. So I want to caution against inferring too much into that. It's important to carve out that the next basically 5 months of this year, we've got a lot that we need to get through, right? We have an election. We have a traditional peak season. We have a holiday season. And we have some unprecedented demand, which is associated to the coronavirus and people working from home. So over the next 5 months of 2020, any straight line analysis is probably going to be inaccurate. But we have some indicators that reflect that the market is going to skyrocket on us. And some they say that's going to basically flatten a little bit on us because it's not sustainable. But the only thing I can tell you is that this is the most volatile time that we've seen. So it's not necessarily something you don't want to delete it. You just need to understand the elements that are in play. So we shift from a bank analyst report and move into a DAT. So DAT is an industry aggregator of information from shippers, TMSs, carriers, and logistics service providers. And so that we all contribute load data to DAT. DAT ultimately creates a national load to truck ratio. A national load to truck ratio is exactly what it sounds like. It's how many loads do we have against how many trucks that we have in the market. And when you're at 2 to 1, we consider the industry to be relatively balanced. I know that's basically sounds weird because it's not 1 to 1, but at 2 to 1, it ultimately means that we don't have enough volatility for rates to change, and so we're going to cover the loads. Once we get over 2 to 1, you start feeling pressure from the demand side. And by the time you get to 4 to 1, we are at a situation where it's ultimately what we would call hot, or in a situation where the pin action or the next reaction of bid data starts happening. So rates start to climb, operations start to break, waterfalls definitely start to break. But ultimately, once we get to the 4 to 1 ratio, we start seeing the downside impact of demand on supply. So it's important here, like on this chart, that I would carve out a couple of things. The first is you'll see that we have a traditional pattern in 17, 18, and 19. While they change up and down and we see load to truck ratios, ultimately you see a weaker front side of the year, a surge in the summertime, and then kind of a tailing trail toward the end of the year. Now, over the years, the demand can stay more consistent. So you'll see 2019 was the weakest of the years. But ultimately, the pattern's similar. With coronavirus this year, we had a complete break in the pattern. And so we had a huge surge in March, coupled by an complete economic shutdown following that. And then what we see now is unprecedented growth and a complete break in the pattern. And so then again, this is one of those things where you look forward and are trying to understand what's next. But as long as demand maintains where it's at right now, we're going to start seeing rates continue to climb, and we're going to start seeing pressures on overall supply chains. One of the other key components of this chart that that's worth noticing is we had our first sub-1 load to truck ratio in the history of aggregating data, and that is ultimately the result of us shutting down the U.S. economy. On the next slide was ultimately what I referenced, which is that you start seeing rates result. So once demand goes, the rates follow. So as demand continues to climb and the load to truck ratio gets at or above 4, the immediate reaction is in the transactional rate world, the rates begin to go. And then we also have a systemic pattern that we pay attention to when it comes to contract rates. Contract rates can and will break if spot rates or transactional rates continue to escalate. And so what you see here ultimately is, again, I pay attention to two things when I look at this chart. I look at volatility, and so the up-down elements of the wave, and then I ultimately look at where they are on the left side. And so in 2018, we had some sustainable dry van rates, or it's basically a 7-day rate per mile average that excludes fuel. But they were all sustained above $1.75 for almost the entire year. And then in 2020, you start seeing that we have a significant increase. It's directly resulted to demand. So we had the wave from coronavirus start on about day 67. And then ultimately where we're at now is that we're starting to see that the rate per mile is starting to climb. It's now above 2018 levels, albeit the tail end of 2018 levels. The last thing I'd point out on this slide is basically in 2017, we had some market anomalies that hit with hurricanes and ELDs. And what you'll notice here is we had a 60 cent per mile increase in 2017 from the low to the high, which was represented by the yellow line. But it took us an entire year to go up 60 cents. And in 2020, we've gone up 65 cents in 80 days. So now we shift to FreightWaves. FreightWaves provides a great chart. It's a little more dynamic. It gets to a daily level. But FreightWaves, it gives us the ability, two things on this chart. The shaded blue area is the overall demand. And what I mean by that is it ultimately aggregates data from TMSs, from major shippers that has all of their contract freight. And so the amount of truckloads that are pushed into a market. They took historical data and they came up with basically an industry average of about 10,000. That's what we consider to be not flat and not weak, but ultimately a balanced market. So something around 10,000 is going to means that there's not a lot of pressure on either side. But once we start going above those, you'll start seeing that the demand is putting too much pressure on the supply side of the fence. So this is a trailing 12 months. The other key component to this chart is the green line. And the green line reflects what we call tender rejects. So ultimately, when you have contracted rates in a TMS, shippers tender those out, carriers just accept them. There's a rate that's agreed to. But sooner or later, shippers or carriers start saying no. And when they start saying no, that ultimately activates either what we would consider to be a waterfall failure, but it ultimately activates a spot market move. And those spot market moves are called rejections, and those rejections are reflected in the green line. You'll see that they follow a similar pattern. This shouldn't be a novel idea for anybody, but when we start seeing rejections increase, it's usually because the overall demand has increased. So you'll see that the green line has a similar pattern to the blue line, with the exception of some dips that you'll see. But like the end of the year in December, most contract carriers are going home, or drivers are taking paid holiday leave. which ultimately meant that we'd have a declining environment for overall volume, but a huge increase in rejections. That literally is exactly what I just mentioned, which is drivers going home, taking paid leave, and meaning that the freight that still needs to get moved through the network moves in a rejection status or ultimately a transactional status. What you'll see here is ultimately 2019. If we went back another 12 months, you'll see that we hovered right around the 10,000 mark. But in the last 6 months, we've introduced a significant amount of volatility, but we've also seen a huge surge in demand. One of the reasons why 2019 was so flat was we ultimately didn't have any weather anomalies. Last year was a traditional shipping pattern, and we didn't have any pressures come from hurricanes or pressures come from other events. And this year we actually have multiple things happening over the next 5 months. And we've also had a global pandemic, which has changed the demographics of the truckload market right now. So we'll take a narrow dive into the last 6 months. And this is important. And it's important to carve out a couple of things. And so I'm going to pause here and speak a little bit about COVID-19. So COVID-19 is this first hump that you see on the left-hand side. And what this ultimately means is that the consumer staple stayed hot. So in March, we basically sent out a national message that said, please buy toilet paper. I'm not sure it's entirely accurate, but that's what the message was. And then go buy consumer staples for your house. So everybody went out and said, hey, listen, I need to buy these things. And so we left essential trucks on the network, and they kept driving freight into the facilities. That's that huge surge that you see. And then subsequently, after that surge, you saw a shutdown of the U.S. economy. And when you shut down auto companies and you shut down Boeing and you shut down restaurants and tourism, trucks basically don't have anywhere to go. Essential trucks stay on the road, but ultimately they needed to go home too. So trucks aren't automated yet. We still have drivers in them, and they need to go home and they need to park. And so that's what they all did. And so we saw a complete retraction of demand on this chart, and as we shut down the U.S. economy. What happened after that, however, is kind of the thing that changed the game. And so the biggest thing that changed the game right now is the fact that we had a change in consumer behavior. So consumer staples came back online. People are still buying toilet paper, paper towels, Clorox wipes. We're buying those at a record clip, but we're also home more. And so as we work from home, we're buying more stuff. We're doing more things in our house. And for people that were impacted by the highest unemployment rate since the Great Recession, the Fed stepped in and provided supplemental income to businesses and individuals. And so consumer sentiment stayed positive. It's not incredibly positive. There's still an incredible amount of uncertainty, and some people aren't happy. But overall, they're being subsidized, and they're actually they are buying things, and they're demonstrating the commitment to the economy that we didn't anticipate. And so we saw a huge surge in demand from ultimately the middle of May through current state. And this continues in a real-time snapshot as of this morning. This index is over 14,000. And so it's important to carve out that everybody is kind of has a positive sentiment, and we're buying things right now. Now, again, I spoke to this earlier. The next 5 months, it's going to be interesting. If the Fed stays engaged, I anticipate that everything's going to be good. The stock markets are at record highs. If the Fed continues to backstop everything, then consumer sentiment should stay positive. We're coming into our peak back to school season, as well as our holiday season. And I don't see a change in customer behavior happening anytime soon, meaning that people are still going to be working from home. And we've made it incredibly easy for people to shop from home. And so I do anticipate, if all things being equal, that we're going to see demand continue to climb. But it's funny when you say that, because we also have the highest unemployment since the Great Recession, one of the most volatile election periods coming up, and the worst GDP in the history of the United States. So you still have to understand that it's incredibly uncertain, but the things that are in place right now reflect sustained demand. Moving on, we shift from freight waves into truck stops market demand index. And I spoke to this earlier, and this will be, it's important to carve this out, is that this is just yet another index that validates the stories that are in play right now. And so if you look on the left-hand side, You see this, we also have similar historical patterns. And this is a completely different data set than DAT or freight waves. But we have similar patterns in the lines, and we have similar volatility in the lines, with the exclusion of 2020. 2020, again, breaks the mold. And so if you incorporate 2016 in the left-hand chart, it's important to carve out that that was basically a freight recession at that point in time. But we definitely didn't have an economic recession. We weren't moving any freight. Nobody was buying anything. All things were being equal. And you'll see that the market demand index was completely muted in 2016. It had some incremental growth in 2017. Then the hurricanes hit, 2000 and ELDs hit. 2018 in the green line represented a huge surge in demand, then a retraction, a flat line 19, and then a coronavirus 2020. On the right-hand side, it's another important carve-out that you have in regards to volatility, is that the average year has about 18 points in volatility. And this year we've had 3 different events that have resulted in 18 points worth of volatility. The climb up from COVID, the shutdown after, and then the subsequent significant climb the following weeks. But it only took us 13 weeks to go up 57 points in the market demand index. Again, this is unprecedented, and it's level setting something entirely new as we go into 2020. All right, the last slide that we have as regards to the state of the market is DAT's dry van load to truck ratio as it relates to a heat map. One of the reasons why I wanted to put this in here is ultimately to carve out a couple of things. This is from July. July very rarely is busier than June, but this year it is. And you'll see that the heat map, it breaks it down. So instead of being a national average, you'll see that it's drilled down by a state. DAT does a great job of actually drilling this down to actual market levels. But the state level I thought was pertinent for this discussion today. Anything greater than 5.5 just means, oh man, is it going to be tight? Everything's going to break. Contract capacity, if it sustains it's greater than 5, contract capacity is going to break. There's certainly no surge capacity available. Spot rates are going to continue to climb, and we would expect service failures in regards to pickup times, meaning that if you have a load that's available on Thursday and you're not talking about it on Monday, we're going to run into issues covering it on Thursday, or you're going to need to pay, shippers are going to pay higher than market prices, significantly higher than market prices, in order to cover that load. So anything greater than 5 to 5 is significant. The reason why I carved it out on this slide is because this is ultimately 2 things. This is the coronavirus at a global level, as well as in China trade and the impacts of nearshoring of major companies. And so in July, we had coronavirus, which was a significant global pandemic that changed everything. But ultimately, it also brought back trade with China and imports, which represents why California is at a 5 to 5 or greater than 5 to 5. But you'll also notice that the border states are entirely red. And that all is a huge signal that we are imbalanced in Mexico, which we are. And so all those crosstowns means that anybody that basically stopped doing operations in China, moved them to Mexico, we are now in a situation where production is coming back online. And with production coming back online, you're starting to see these border states remain really hot. And that's not going away anytime soon. All right, so now we'll move from the state of the market, which is ultimately just validation from various indexes on where we're at now. And they're going to take a shift into ultimately what are the patterns that I spoke about earlier that are consistent year over year, as well as some of the non-traditional patterns that we've seen. So there are 3 patterns that happen in a traditional truckload market. There's ultimately our seasonal demand, there is the annual procurement, and then there's market capacity. There's not much to this except for the fact that this is traditional and doesn't necessarily incorporate anything that happens to do with weather anomalies or whatnot. So it's very important to understand that for every lane and every trade pair in the United States walks through these 4 steps. And so you have a quiet season, your produce season, which again, it varies by region, from onions in Atlanta to avocados in Mexico to apples in Washington, and even Christmas trees in Washington. It varies. And then you have your traditional peak season, which is everybody prepping for back to school. And then the final thing is going to be your holiday season, which again represents the highest amount of consumer spending. So one of the things I wanted to stop and pause right here and just carve out is the fact that annual procurement, we're going to talk for the rest of this presentation, we're going to talk about the difference between contract and transactional freight. I don't want to downplay transactional freight. Contract freight is exceptional. It helps clients forecast supply chains. It puts an ease on operations. It puts an ease on FP&A. It helps maintain capacity. It's certainly desired freight. It's desired freight not only for the shipper, but for the carrier. As I spoke earlier, is that the carriers that start in this industry or buy a trucking company that's small and want to get better, they build networks off of contract freight. So if I have 3 trucks that I know every week are going to go to this certain market, I can build off of that. And so it's important to know that contract freight is the desired output, but obviously most things can't go contractually and you have to pay attention to transactional. So while we spend some time talking about contracted freight and the risk associated with transactional freight, the key to this for any shipper is to mitigate the risk in a transactional environment. And so most shippers at Redwood, we run somewhere between 1,100 and 1,300 bids a year. And so most shippers take their business out with the intent to try and find contracted rates. They do that starting in September and run all the way through January. It's a bid season that's intense, but ultimately what clients are doing is they're level setting a forecasted spend and capacity for the 2020 season. Excuse me, for 2021 season. The reason why you do that is what we just spoke about, is it's basically to hedge the spot market exposure, which we just went through is at a peak. It's at its peak. I think there's only one index that was above 2018, but not many. And so we try to mitigate the volatility and reduce the risk associated to that. Most customers go live and bid in Q4, Q3, and Q1, but we have seen a pattern, and this is a pattern that is recommended, is we have seen a pattern that we break off supply chains. Supply chains change. They certainly are dynamic throughout the year. Capacity shifts. And it's important for customers to be nimble and react and actually bid freight out in a faster fashion. And so it doesn't necessarily mean that you're hard and fast and locked for 1 year. It does mean that you can do that, but I would also encourage supplemental bids at a quarterly level or a biannual level to help mitigate some of the risk. But also it's not about mitigating risk. It's about basically reacting to changes in your supply chain. All right, so that the first one is the annual procurement season, and then the second one is basically market disruptors. And so there are 3 things that disrupt the market. Not 3, there's 3 segments that you would put in that would ultimately disrupt the market. The first one is global. This is the first time we've done this. Most things aren't global. So a weak economy in Germany doesn't have a huge impact on the United States. A weak economy in Europe as a whole would have some impact on the United States, but most of the stuff that we do in the United States is consumed in the United States. And so it's important, most of the stuff that we move in the United States is consumed in the United States. And so for that reason, this is the first global pandemic that we've had to react to. And this was significant. It repositioned ships, right? It repositioned everything, goods, all of it. And so economy slowed to a halt, then reopened, then closed again, then reopened, then closed again. And people certainly put things in different perspective. And so economic trade was important, but it certainly wasn't the most important thing. The other thing that we had was we had a significant amount of unemployment globally, as well as a complete shift of employee behavior from working at home to working at home rather than working in the office. We had ports entirely closed, which again, when a port closes, you end up having at a 10,000 TEU level, that's 10,000 different shipments that aren't going where they're supposed to go. And you do that on a daily basis when globally it's a significant amount of freight that's just not where it's supposed to be. Inventory levels certainly are off right now. So because of the demand that we've had in the last 6 months, inventory levels have completely shifted and have depleted. And so we're starting to see imports surge to try and rebuild inventory, but they have to keep up with sales, and the sales to inventory ratio is off. And then the last thing we have is we have a global uncertainty in how long this is going to last. and you certainly have opinions on what's going to happen, but for the most part, we have global uncertainty on what's next. At a national level, the market disruptors for COVID-19 are very similar to the global ones. I think the only comment that I would like to make and kind of echo home is that the drivers are victims to coronavirus as well, right? So you have to understand that drivers do get coronavirus, and then you have to do contract tracing to other drivers. Did they stay in the same hotel, over the road hotel or terminal? Did they check in at the the LTL terminal? What was their contract tracing there? They have to go into a mandatory quarantine. So there's huge impacts to the driver getting it. The other thing is that a driver is going to end up at a shipping facility or a consignee facility, and they may have it. So while the driver may come in and have no symptoms, he's at risk by a facility that may or may not have it. And then if the facility has it, they have to close. And so you have all the inbound trucks that are going to these facilities that are closed, and they end up impacting the supply chain. So it's the sentiment here is ultimately that one of the reasons why demand went through the roof and supply hasn't followed is because we can't get the supply right. We all went home, the networks reset themselves, and it's going to take us time to get all the supply back into the market to basically match the demand that's in play. So demand's gotten healthier. There is a lot of trucks in the market. We just have to watch the trucks because they're playing by a new set of rules, and they haven't necessarily gotten back to the networks that they had pre-coronavirus. And then the last thing that's important to bring up is we have 2 hurricanes that are coming into the Gulf Coast. And there's 2 things that happen when it comes into the Gulf Coast. First of all, is it's going to cause damage, right? And it's going to cause concern. So we want to be safe. So we pull trucks and equipment out of markets to be safe. And then right after that, you send all the trucks back in with goods, right? With bottled water, with lumber, repairs. But the pull out and the push back in change the way supply and demand happens, both at a specific market level and then more importantly at a macro level. So trucks that are usually in the Carolinas end up heading into Florida, and trucks that are in Memphis end up heading into the Gulf Coast. Same thing for Dallas. They start supplementing the need for wherever a regional disaster might happen. The other comment I would make on disasters is that when it hits the Gulf course, it takes oil offline. So when you're used to producing $1 million barrels of oil a day, and you have to take that offline, it changes the supply and demand of oil, which I'll speak to in just a couple of slides. So I took 2 snapshots of that information as it relates to COVID-19 and the impact that it's had. And so you'll notice that on this one, we looked at volume, and anything that's in red is 30% higher than what the market will bear. And then anything that's in dark blue is about 30% below what the market will bear, meaning that supply far exceeds demand. And if you look at the chart on the bottom, it's a great heat map line chart on the bottom. And it basically shows you the surge in March, the flattening in April and May, and then the subsequent increase over the months of end of May, June, July, and into August. But you'll notice here that we ultimately only have 3 states that don't have a supply and demand. And this speaks exactly to what I was talking about, is the trucks are in the market, they're just not in the right spot yet. It's going to take time for the trucks to get back into the market to get to where they're supposed to be. The next slide ultimately is rates. So again, the first byproduct of demand is the raise in rates. And so you just look at the rates over time from March to August, you'll see that rates climbed significantly. They were relatively flat and muted in March. And everybody at that point in time was expecting a 2020 that was going to be basically not flat and muted, but pretty close to flat and muted. And now all of a sudden we have a reset happening in the truckload market. So the reset is clearly reflected in these rates. And it shows that, again, as demand continues to outpace supply, that rates are going to continue to climb, especially in the transactional world. All right, this is what I spoke about earlier in regards to the cost of fuel. So a couple of things I'd carve out for fuel is that the U.S. produces a ton of oil. And West Texas intermediary is about 51% of the oil that we produce. And so what you look at is the price of a barrel of oil as it relates to the truckload demand. And so if you look at it in July of 2017 through the run up of 2018, both the red and yellow lines, you'll see that as fuel went up, so did the demand on the truckload side, the supply and demand metric on the truckload side. There's two reasons behind this. First and foremost is as oil gets more attractive and costs more money, they open more wells and send more trucks in. So we lose capacity that traditionally is in an over-the-road environment, and they start going to the oil fields. It's a more lucrative contract for the trucking company. It's a more lucrative contract for the oil company, but we certainly lose drivers to the oil industry. The second thing that happens is consumer spending goes down. And so as we have to pay more for a gallon of gas, we see a change in the demand in the demand curve. People start paying attention to what they're doing and how they're doing it. So you start seeing a contraction of the supply and demand curve as they come together. And a flattening, like you see in the green line over here, where everything overall, oil is relatively consistent in 2019, is we had a surge earlier in the year, but it's certainly re-regulated. And as it re-regulated, you saw that that's a balance. That means that trucking companies became more stable. They knew their operations, and that ultimately the demand side of the fence, there wasn't a lot of volatility there. And so it didn't put any pressure either on the supply or demand curve. And then obviously this chart's a little off right now because there was a point in time during coronavirus where we actually were paying people to take oil from us, which is awkward. But that's what was happening. And so the chart doesn't necessarily reflects a significant dip during coronavirus that I would just consider to be an anomaly. And I would basically focus my efforts on the fact that as long as fuel stays in the mid 40s, we're going to see it's not going to be a pressure point for the supply and demand curve. But if it gets higher again, we will start seeing a pressure point in the supply and demand curve that's a direct relation to the price of a barrel of oil. Okay, so that ultimately takes us away from the cycles, the traditional shipping patterns, and now we move into contract versus transactional rates. And this is important to carve out and just echo my sentiment from earlier. Contract rates are desired, but you cannot be attained for everything. And so you want to carve out what you can in the contract environment, and it's good for all parties. It's good for the shipper, the forecasted supply chain. It's good for the logistics service or provider to help manage a supply chain. And it's good for the carrier who they can continue to build networks off of. So there's nothing wrong with contract rate. It's just important to know that not every square peg was in that square hole. So you need to understand how to manage the transactional capacity as well, both for the trucker and for the shipper. So there's factors that influence carrier capacity and rates when it comes to contract. I just talked about fuel. It's their number one expense at an operating level for a trucking company. And for a shipper, it's important to note that you can use a zero trigger, 5 cent per mile step pattern for your fuel surcharge. You can use a $1.50 trigger, a $2 trigger. You can use whatever trigger you want. You can use 6-step patterns, 5-cent step patterns. You can use breakthrough fuel. All of those things are fine. The key is make sure they're uniform. Make sure that the carriers understand that they're on one fuel surcharge. And a logistics service provider or yourself can house that fuel surcharge. The important thing is to make sure that you have one consistent one so that you can ultimately understand what a true line haul rate is. Again, both the carrier and the shipper benefit from a consistent fuel program. The next thing is accessorials. It works both ways, where you want a carrier to basically be compensated for detention if you are a 6-hour loading facility. If you want all 6 hours for free, that's fine. It's just going to compromise your line haul rate. They're going to add the accessorials in. So the key there is ultimately to understand what are the accessorials by each of your facilities and understand that they're going to compromise the line haul rate if they're not transparent. I'll speak a little bit later in this presentation to how visibility is helping with accessorials. The other thing is going to be facility profiles. The more information that a carrier or logistics service provider can get, the better the rates are going to be. And transparency is critical on this one. The next thing is the length of haul. I'm going to pause here and go on a bit of a diatribe because this is important. The length of haul is critical for drivers at trucking companies for their network. And so if you have a 200-mile length of haul out of Denver, that basically puts you in the middle of nowhere. But 200 miles from Toledo, Ohio puts you in about 12 different major metros. And so it's important to understand what the length of haul is for in the origins that they're coming from, so that drivers can optimize their network. If it's a 200-mile run on a given day, they need to do something else with that truck. So the odds of getting a backhaul for the same hours that you sent them on, it's difficult, right? So it's important to understand what is the length of haul, and carriers look at that to help manage their deadhead and what they need to do with the truck after they've left for 230 miles, whatever it might be. Now, again, supply chains aren't that easy to fix. I just want to comment on the fact that length of haul is a key indicator on what a rate per mile is. The next thing is going to be, I mentioned earlier that we do thousands of these a year, and weekly volume by year is critical. And so a lot of times we see annual volume, but we don't see it spread out by month. We would love to see it spread out by year. And the carriers would benefit from that as well. Again, they can build networks to lower your line haul rates. And so it's okay to have 3 loads a week on average and surge to 6. But what doesn't work well is when you get a rate per mile for X, that basically is let's say 2 loads a week, and then 24 annual loads a year, and you give all 24 of them on the last week of December. That is not it's not going to be a valid line haul rate. It's going to end up breaking. So it's important to basically pay attention to volume. Again, at a shipper level, this is going to give you the best rate. And at the carrier level, it's going to give you the best. They're going to basically build a network and a relationship off of it. And then volume by origin and destination are kind of self-explanatory, but the carriers do look at consistencies when it comes to where they're going. It's not necessarily just a lane level, but if you have 10 loads a day that leave the Chicago market and head east, we're going to be okay. You're going to get good aggressive line haul rates. And if you also have 10 loads a week that basically originate in the Midwest and terminate at a single point in Atlanta, you're also going to get good aggressive rates from that carrier. They can build a network off of those. So it's important to carve out volume by those beacons in order to generate the least line haul rate. And so this is a different approach than just procurement, raw procurement events where you're just basically comparing rate per miles. This is a different approach. It's basically taking a deeper dive into the data in order to afford the best rate, and then compare those. Those will be the truest rates for procurement and the ability to forecast supply chains and ease operations. Transactional capacity is basically the complete opposite. So fuel is not a component. It's usually all in, and it entirely goes off of market conditions. And we'll talk about lead time in a following slide. So a couple other points to make on contract versus transactional and how to navigate the two of them. It's important, like 80% of the truckload rates are in a contractual environment. It doesn't mean necessarily that they operate there, but they're desired to be there, meaning that they have a rate. It may not be honored in today's market conditions, but there's a rate on file that's contractual. And 20% of it is in transactional. Most of the time when you have a contractual, it's a rate between a shipper and a logistics service provider, or a shipper and a carrier. The difference between a logistics service provider like Redwood or a carrier is that you may have 10 loads a week on a certain lane, and if you had 10 loads a day on a certain lane, there's not a lot of carriers that have 10 trucks in the same market consistently. I just spoke to my point earlier about 5%, right? So what you want to do is use a logistics service provider to aggregate the capacity for you. So you have 4 or 5 to 6 companies that can run that lane on your behalf, or you can go find 4 or 5 or 6 carriers that'll run that lane on your behalf and contract them directly. There's a game to play there between using a logistics service provider and contracting the carrier themselves. A lot of it comes down to risk in the actual contract with the carrier. It comes down with payment terms, tracking, FP&A. Those are values. Those are things you want to pay attention to when you're contracting high volume lanes. It's obviously based off of an expected volume. Right now, we're in a situation where volume that is over the agreed to bid award is being rejected, meaning that a trucking company is going to say, I'll do 3 a week. Demand is incredibly high right now. They've got 6 a week, and trucking companies are not offering those 3 additional trucks. It's one of 2 reasons. A, they don't have them, or B, they're in the spot market right now, and because the rate per mile in the spot market is higher than the contract rates. The last thing, or a couple other things that comment on contract rate, is usually it's an average of 6 to 12 months. Those are the desired terms. Again, too much changes to go past 6 or 12 months. Most of the time, contractual freight comes with some consistency and some lead time. But the last point here is probably the most important point, and that is heavily influenced by spot market. So as spot continues to just basically skyrocket right now, contract freight it's still incredibly appealing both for the shipper and the carrier, but the base rates are starting to climb. On the transactional side of the fence, again, I'll speak to a slide in just a second, but ultimately this is, you're buying what the market bears, and it's in an all-in rate. So I won't go too far into this. It's basically, again, what goes into a contract truckload rate. I think the only other comment that I would make here is going to be seasonality does come into play, the commodity comes into play, and the facility profiles come into play. We spoke to it earlier, but being a shipper of choice incredibly helps line haul rates. The commodity helps line haul rates. If you're shipping unpackaged light bulbs, your rate per mile is going to be high because they need to mitigate claims and risk and liability. And then obviously seasonality comes into play, meaning that if you're really busy with northbound freight from Mexico during avocado season, that rate's going to be higher than if you weren't. And so there is a base component to line haul rates that is associated to seasons. On the transactional side, all things are the same with the exception of a couple of things that I would comment on. Is A, timing and flexibility, meaning that do you need it in 2 hours? Can I pick it up tonight? I need a deadheaded truck in. Can we do it tomorrow morning at 6 a.m.? I've got a truck that's on delivery right now. He just needs to reset his hours. Timing and flexibility ultimately helps mitigate some risk in the transactional world. Fuel cost, as I mentioned earlier, is an incredible component of transactional rates. Requested service, meaning when do you need that delivered by? Is it an appointment delivery? Is there a penalty for being late? All of those things come into play in transactional rates. And then the last thing is, and it's a key component, it's head haul or back haul. I spoke earlier about how carriers build networks. Their desired output, the cost of running a trucking company is incredible. They want to be able to build a network. And so if you have a load that's transactional, that puts them back in a head haul market or back in their back haul market, that's going to lower your rate. 90% of the loads that are searched in a load board by a trucking company are not for the head haul or back haul. It's for the intermediate load between their head haul and their back haul. So most trucking companies don't just drive from Chicago to New York and then New York to Chicago back and they're done for the week. It's usually Chicago to Toledo, Toledo to Columbus, Columbus to Memphis, Memphis back to Chicago. And they got to do some searching for those loads. And that searching for those loads for those intermediary truck runs is where if the freight is offered to a head haul or back haul, that's when the trucking companies is more attractive for the shipper at that point in time, and again beneficial for the trucking company. So the rates are going to be lower and we'll be mitigating risk. All right, the last slide that we have as it relates to the for the difference between contract and truckload, really hunkers down on transactional freight. Like I mentioned earlier, it's risk mitigation. It's a reality in our industry. It's fragmented. It's gigantic. It will always happen, especially as the cost or barrier to entry and quality of life for trucking companies remain the same. It's important to note that they're always going to stay fragmented. So it's going to be, how do you mitigate risk? One of the ways to mitigate risk is to leverage a logistics service provider or a broker. Finding trucks for transactional freight at a shipper level is very difficult. So you want to make sure that you're leveraging somebody, a logistics service provider, that can afford you what this side graphically lays out, which is basically lead time. So if you have greater than 72 hours for a transactional load that you know you're building at production, then you end up leveraging network capacity from a broker. Most brokers have a Rolodex or stable of carriers in their network. And so when you get to that level, you're basically buying network capacity. The broker, logistics service provider, knows when they're going to have a truck in that market in advance. And they start negotiating the rates and getting everything set up for the shipper well in advance. So you end up leveraging network capacity. The same thing applies to 3 days in advance. You end up leveraging a logistics service provider's network capacity. These are contracted carriers with known trucks. They're safe. For the most part, this is most brokers, but you have safe network driven capacity. You have visibility, you know where they're at. They have a lane, they have a pattern of buying. It all works at 3 days. You have network capacity. Even at 2 days, you understand that there's a network capacity component that you're going to be able to leverage. Length of haul comes into play here a little bit, but for the most part, a 2 days notice, you're going to end up leveraging network capacity, which again will provide lower rates as we try and mitigate the risk in the transactional environment. At 24 hours, we get out of network capacity and we move into market capacity. And market capacity is ultimately exactly what it says, which is I'm buying trucks in Chicago. So I'm not, if I had a truck that was inbound from Columbus going into the Chicago market and I knew 2 days in advance, I can book that truck. But if it's only 24 hours notice, that inbound truck from Columbus is not going to be offloaded in time to handle that truck. So now I got to buy trucks that are in Chicago, or if I'm in, pick any market, Orlando. If I'm in any market, you buy market capacity with 24-hour notice. It's not network capacity. With that comes the supply and demand curve that we mentioned earlier in this. And that supply and demand curve basically dictates the rates that you can have. There's not a lot of leverage. It just comes down to, can you find a truck and move my freight? That's what we have with market capacity. And in same day capacity, that's ultimately the last thing that you have. It happens all the time. It's a known commodity in every supply chain. It's okay. It's just one of those things where the rating risk is at its highest on the same day, because now we're not in market capacity, we're in demand capacity. So when it's 5-to-1 on a load to truck ratio, there are 5 loads in 1 truck. The winner of that truck is the guy that pays the highest rate. The trucking companies know that, the shippers know that, but you're ultimately playing the demand curve at that point in time. Because another thing that we identified earlier is that the patterns don't change that quickly. And so what we noticed is that if it's 5-to-1 today, it's going to be 5-to-1 tomorrow. It's going to be 5-to-1 the next day. It's not going to change from being 5-to-1 until we have a market shift. And for the most part, those don't happen overnight. And so the demand capacity is by far the highest rating risk. And as much lead time as you can is going to be able to limit your risk when it comes to truckload rates for transactional. I will jump on this slide. We only got about 6 more minutes, and I want to just touch briefly on the technology. But if you look at this slide, this is ultimately contract rates versus transactional freight. You'll see here that in the bottom chart, it's the difference of the two of them. And in 2018, you'll see that spot rates exceeded contract rates. And in 2020, we're about to do that. I would anticipate that if demand continues the way it is, and the trucks are not where they're supposed to be like they are as they came off of the economic shutdown, I do expect that the network is going to basically flip-flop and spot rates are going to exceed contract rates in the near future. All right, so moving on, we'll go to technology. And technology can be, for the truckload market, can be just basically set in stone in 3 key components. The first one is visibility. Visibility changed everything. And so something like Amazon changed everything. The ability to see what you want to do it in a quick fashion and see where the packages are, no one's going to get delivered. That behavior is starting to enter into our trucking market, which is great news for everybody. And so smartphones are starting to find their way into every cab in the United States. If they don't have a smartphone, 9 times out of 10, they've got an ELD. They don't have an ELD, we've got a trailer tracking device. We've got operating systems if they're a larger fleet, but ultimately connectivity is paramount. And this is table stakes now. So you need to make sure that all of your carriers are connected to you or to a logistics service provider so that you can see this visibility. There's an incredible amount of downstream value in visibility. Government mandates basically made it requirement that everybody has an ELD in their car. Those are ultimately beacons. Some of them are broadcast position, some of them don't. But ultimately, the government forced people to basically identify where they're at, and how long they've been going there to make sure that everybody's safe. Again, I mentioned table stakes. There are a number of people that are in the visibility sector. You can see a couple of them listed here. I would consider those the best in breed. And it's important that, again, this is table stakes in the supply chain. We want to make sure that everybody's in visibility or has visibility. And then the reason why is ultimately the downstream value. But in order to figure out what's best for you, you need to look at your carrier mix and your overall supply chain. And so if you have a significant amount of parcel, reefer, or regional LTL, Those are the things you want to pay attention to when you're making decisions on your visibility platforms. Again, carriers love this. They have no issues with connectivity at this point in time. They want to they want you to help them as well. There's a change in the sea level when it comes to visibility at the carrier level, but you want to pay attention to what is your overall carrier capacity look like in order to develop your visibility platform scheduling. And then the last thing is going to be the scheduling and the value associated to visibility. Once you can see where trucks are, you can make decisions. So if it's going to be late, you can adjust dock labor. If it is an appointment scheduling, you can certainly see all your trucks on the inbound side of the fence. If it's going to be early, you can also adjust dock space. There's a number of things you can do with visibility, which is downstream. A couple of other things that you can do is basically you help with detention and accessorials as a whole that I spoke to earlier. Visibility, drivers are going to be able to say, I hit your geofence, I'm here. And that's going to help you with on-time performance. But it's also going to be able to say, I hit your geofence, I'm not there, and that there's no accessorials that are going to be being built. It's helped FP&A on both sides of the fence. I apologize, I'm going a little bit faster than I wanted to in this section, but I know I'm running out of time, and it's a busy Monday afternoon for everybody. All right, I wanted to speak briefly on a digital brokerage and capacity matching. This is a fancy term that everybody's using right now. It works. It's important to understand that this is something that's being adopted. Most major companies and logistics service providers have a network, and digital freight brokers are the ones that have invested capital into understanding where their network is going to be, not where it's at, but where it's going to be. And the second that you can understand that there's going to be a truck arriving into a network for a client that has a load, that's what we would consider to be a capacity match. And a capacity match that leverages technology gives us the ability to give the most economical rate to all parties involved. You can tender automatically, you can track automatically, invoice and paperwork can all be automated. It reduces an incredible amount of human capital that's deployed to a single truckload shipment. And so, but the only catch to this is that each ecosystem that exists in a digital brokerage is private. And so you have, Redwood has their own, other providers in our space have their own. Those are private networks that we've invested millions and built 20, 30-year relationships with those carriers. And it speaks to the carrier diversity in the very beginning of the slide. But you certainly want to leverage and partner with clients or, logistics service providers that have this freight brokerage that's digital and matches capacity so that you can get the most economical rate in the marketplace, because we're leveraging advanced information on where a truck is going to be, not where it's at currently. All right, my last slide is obviously rates. And so that's the last thing that happens once we've matched capacity and we've identified where trucks are going to be. Now it's ultimately how do we rate things. And so the next iteration of technology in the supply chain for truckload is a dynamic rating API. There are carriers or logistics service providers and carriers that invest in a dynamic rating tool that leverage market conditions and give you a fair competitive rate in real time, save millions of dollars for shippers. So this is the last thing that I would identify is basically say, you want to be engaged with somebody that has dynamic rating API capabilities so that you can leverage if a waterfall fails, you get the most competitive rate. And subsequently, that basically comes off of a matched piece of digital capacity. That's where the industry is going. And it's important that the early adopters, we're past the early adopter stage, and now we're basically consensus stage of this type of technology. So it's important that shippers and industry and veterans like you guys on the phone right now understand that we're here in this environment now where digital capacity is real. Our dynamic rating API is real. It's a waterfall protection. It's real. And it's encouraged to be put in the supply chains. And again, the value isn't just for Redwood or somebody else in this space. The value is for the shipper and it's for the carrier. The carrier benefits because they don't have to negotiate and haggle rates. The shipper benefits because their waterfall broke, but they still have capacity coming. And those are all the incredible values that you have when you look at this technology that's shifting on the truckload market. Last but not least is just kind of the final slide. In the event that you guys have questions or want more information, I'm absolutely more than happy to help. I would just encourage you to look at our website for more additional information on either this topic and various other topics in the transportation industry. And anything that you have that's a question about today's webinar, please email hello@redwoodlogistics.com. Again, my name is Jeff Leppert. I thank you guys all for joining me today. as we navigate the truckload market. Please have a safe and enjoyable remainder of your Monday afternoon.